Okay, so the secret to marital harmony. Put the toilet lid down the seat when you're done. This is an all-male class. This goes for everybody, right? Put the seat down when you're done and change the toilet paper roll out without complaining. Just do it. You're going to be changing a hell of a lot more rolls than you should during your life as a married person, but just get used to it. Just do it. That's actually, I had this conversation with a colleague of mine, and he said, you know what? He said, I wish I'd met you 2 wives ago. I'm like, why the hell didn't you figure this out after wife number 1? Pretty sad. Okay, so last time we talked about unsecured short-term borrowing, and it was things like lines of credit and revolving, we had, let's see, what did we call it? The revolving credit arrangement, and we talked about letters of credit. The compensating balance, that's that craziness where you have to leave some money on deposit with the bank after you've borrowed the money, so it really, you don't get all the money you borrow. Now we're going to talk about secured short-term borrowing. Which of these are going to have a higher interest rate, unsecured or secured?
Unsecured.
Okay, very good. Why will unsecured have a higher interest rate?
There's no collateral.
Yeah, there's no,
Risk.
yeah, so higher risk, so here you go. Oh, sorry. Okay. Now we're going to talk about how we can bring that cost down, and it's through secured short-term borrowing. And the first thing that we're going to talk about is something that a lot of students don't think about. And that is we can actually use our accounts receivable as collateral or security for a loan. And the reason we can do that is accounts receivable, or that's an asset, just like inventory. And so we can actually use it to be collateral. And the first thing that is mentioned here is the assigning of receivables. With assigning receivables, all I'm doing is, in exchange for being able to borrow from the bank or whoever's doing the lending, I am going to assign these receivables to them. Now, assigning receivables does not give them the obligation to collect the receivables. What it does is it says, if I don't pay the loan, then you can collect these receivables that I've put up as security. And so in this one, the borrower is still required to go out and collect those receivables. Now that's good for the lender, because then who is responsible when the customers don't pay their bills? It's still the borrower, right? The lender doesn't have to worry about that. And we get into this talk of recourse versus non-recourse. Once we start doing factoring, which is our next thing, now you can have a choice of having your loan be recourse or non-recourse. In a recourse loan, it means that you as a borrower are going to be responsible for any of these debts that cannot be collected. Versus non-recourse, which puts the risk onto the lender. It puts the risk onto the lender. Out of those two, which do you think is going to be cheaper financing?
The recourse.
Yeah, the recourse, because it leaves that risk on the borrower. It doesn't transfer it to the lender. And in fact, you've got to be careful when you offer non-recourse financing based on receivables. Assume this, you've got a pile of receivables. Half of them are people that are going to pay in a really solid way. The other half are some people that are kind of flaky. And you have to take one or the other of these piles and use it as collateral for a non-recourse loan. Which pile of receivables are you going to put up as collateral? Yeah, the crappy ones, right? You're going to put the crappy ones on. So by the very fact that people are seeking non-recourse financing lets you know that they're a little uncertain, or maybe a lot uncertain, about collecting those receivables. So if I were in this business, I would be very pleased to do recourse financing, but would not want to do non-recourse financing where I would be stuck with the bad debts. So let's talk about factoring receivables. There's two big flavors for factoring, and you can have either one of these be recourse or non-recourse. In both cases, the factor, which is what we call the lender, the factor is responsible for collecting the receivables. The factor is responsible for collecting the receivables. And so I am turning that over to them. Now, it could be either recourse or non-recourse. If they are collecting the receivables and they run into problems getting paid, then they will come back to the borrower and say, hey, pal, we had $100,000 worth of your receivables that we weren't able to collect, therefore you owe us $100,000. Conventional factoring is where I sell something, and I'm going to sell it on 30, 60, or 90-day terms, and I'm going to immediately turn around and sell that receivable to the factor. And I am going to immediately receive the money. With maturity factoring, I am going to sell that to them, but I will not get the money until, say, 30 days from now. So it's going to be a longer period of time until I actually get the money. With conventional factoring, I get the money right now. Which do you think is more expensive? Conventional factoring or maturity factoring? Which is more expensive? Ask yourself time value of money. If you get the money right now, then they're not going to give you as much, right? The required return will be higher because of the time value of money. Therefore, they are going to purchase your stuff at a bigger discount. By the way, that's how the interest is paid here. It's because they only buy your receivables at a discount. And those discounts range from 10 to 30%. And so the discounts are pretty big. What does that mean if you're in a business where the profit margins are only 2%? Should you be engaging in this kind of activity? No, man, they're going to take 10 to 30% and you're only making 2%. And so where do we see this kind of thing happening? Well, the apparel industry is really big on this. You guys know that the margins in the apparel industry are pretty honking big. So you can go into the store and they're selling stuff at 50% off and they're still making money. So when you've got margins like that, you can afford to do factoring like 10 to 30%. So that 10% would probably be maturity factoring with recourse. The 30%, come on in. The 30% might be the conventional factoring with non-recourse. And so the riskier it is for the lender, the greater the discount. Any questions on factoring? Okay, yeah, question?
No.
You're just stretching? Okay.
I was just saying, nodding my head, no, I don't have a question.
Oh, okay, very good. Let's talk about credit card receivable funding. If you've got a credit, if you're working through a bank and you're receiving credit card payments, then that can actually be an asset that you can use to borrow money, usually from the bank that issued the credit card. And this is pretty cool. So I can go out and I can borrow money based on my future credit card receipts. And they'll say something like, we're going to keep 80% of your credit card payments until this amount is paid off, something like that. Now, why do you think your credit card company, the company that takes care of all your credit card transactions, why do you think they might have better information about your cash flow than just some other unrelated bank?
Things here in Boston.
Yeah, they get it. They know what your payment patterns look like. And so if they can see that you're getting these same, let's assume that you're selling some sort of subscription thing, and they can see that your churn is low and that you're getting the same money over and over again, then they're pretty happy to loan you this money, and your interest rate might be lower versus trying to go borrow that money somewhere else from someone that does not have that same information about your payment patterns. So, Amazon. You guys know that Amazon, you can buy a pallet of stuff and send it to the Amazon warehouse and it can sit there. You can actually borrow money against the inventory that you have at Amazon from Amazon, because of course Amazon knows exactly what you've got there. You can also arrange this credit card receivables kind of financing from Amazon. There was an article in the Wall Street Journal when they started that up, and this guy, they were talking to several people who did business on Amazon, and they were all against it. They said, look, Amazon has their hands in my pockets enough as it is. They control too much of my business as it is, so they weren't going to do that. But if you didn't have other options, it might be a good one for you. Credit card receivable funding is typically pretty expensive, but of course everything we're looking at here is pretty expensive. Speaking of the inventory in the Amazon warehouse, we can get loans using the inventory that we have as collateral. And so the first option would be just the blanket inventory lien. I am pledging my inventory as collateral, and if I don't pay, then the bank can come and take that inventory, or at least enough of it to pay off my debt. And it doesn't say which units the bank's going to take. It just says the bank's going to take $100,000 worth of my inventory to satisfy the debt. That's a blanket inventory lien. What do you think some of the dangers might be from loaning people money on a blanket inventory lien? What could people do?
Who decides what inventory they get?
So once the default happens, the bank comes in and snags inventory at its discretion. But the bigger question is, who decides what's actually in the inventory? And that's the borrower, and that's the snaky part that I'm getting to. So there was an electronics dealership. They were selling television. They were a big thing. I forget the name. But they had a blanket inventory lien. And, of course, being a good banker, they would send this old guy down to verify that the inventory was there. And so he would go down and they would offer him coffee and donuts and whatever, and then they would take him out into the warehouse. And he would see these huge stacks of televisions, and he would mark down, he would count the number of rows and the number of stacks, he would and do the math and figure out how many of these TVs, and he would look at the value of them, and he would figure out what's the value of their inventory, and he would say, yeah, it's fine to keep loaning these people money. Then the old guy retired. By the way, it's a true story from the Wall Street Journal. The old guy retired, and they hired a brand new 22-year-old accountant straight out of school to go out and do these sorts of checks. And they bring him in, and they give him coffee and donuts, and then they take him out to the warehouse, and he's looking around and he's counting and he's doing the math and everything's just fine until he says, one more thing, get a ladder. And they said, what? He says, you guys certainly have a ladder around here somewhere, don't you? And they said, yes. And they put the ladder up, and the young man climbs the ladder and looks down, and lo and behold, what these people have done is stacked up these televisions and created a hollow center. And so when you just did the width times height times depth, you would get a different count of televisions than if you actually looked down in there and saw what they were doing. That was the beginning of the end for that electronics dealership. One other thing that's going on right now, there's an automotive supplier called First Brands. If you've ever bought a Fram oil filter, that's one of their products. And they were actually doing this receivables financing, and they were creating fake receivables to get loans on the receivables. Now, is that something you can keep up forever? No, the money has to eventually come back to be able to pay that stuff. And eventually they got caught. And the big problem was the guy at the top wasn't just borrowing this money and then reinvesting in the business. He was borrowing the money and then siphoning it off for his own personal use. And by the way, once someone siphons the money off and they've taken vacations and bought yachts and all that sort of stuff, do you think you're going to get a good recovery on that? No. And so you have to watch out for people being scumbags. Then we have the trust receipt. If you have an item that has a serial number on it, like an automobile has a vehicle identification number, appliances have serial numbers. So if you've got something like that, then you can borrow money against it using something called the trust receipt. And the trust receipt actually is linked directly to the serial number or serial numbers that are used as collateral for that. And so basically we know exactly what these things are worth. We know exactly if we needed to go check and make sure they actually had the collateral, we could do that. So who's using that? You know, when you go to a car dealership, you look at all those cars. Do you think they bought all those cars with cash? No, they buy them with credit. They buy them with these trust receipts. And the same is true when you go to an appliance dealer. An appliance dealer will borrow money through something called a floor plan. It's called a floor plan because you're using it to populate the floor of your appliance store with these different models. And all those things are basically this idea of the trust receipt. But what if you can't trust people at all, even if you've got serial numbers? Well, then you could do what's called field warehouse financing. Not only am I going to provide you the capital to acquire this inventory, which you will then use as collateral, I'm also going to provide warehousing services. Now, why do you think, or actually, let's ask this, what do you think is riskier for the lender, the blanket inventory lien or the field warehouse financing?
Field warehouse, or that blanket is more risky.
Yeah, the blanket's more risky because you're not controlling the inventory and you have to go check on it like the guy with the ladder, right? But if you've got the field warehouse financing, you know with certainty how much of their inventory is in the warehouse. And so the financing cost is going to be lower for field warehouse financing. However, what other costs are you going to incur? Yeah, you're going to pay them for A, checking in your goods, B, sheltering your goods, and C, checking out and shipping your goods. And so field warehouse financing may actually be a little more expensive, but you're getting additional services. By the way, when you do factoring, you are getting an additional service because you're not the one having to collect the receivable. Collecting receivables is costly and time consuming, and some people may be better at it than others. And so it makes sense if you're the kind of person like my buddy's dad who had a soft heart, it would be so much better for him to have someone else collect the receivables. So that's an additional value that you're getting out of factoring. Down here with field warehouse financing, not only are we getting financing, we're getting someone else to warehouse our goods. You think it's possible that some people could be better at warehousing things than others? Oh yeah. If you look at an entrepreneur, do you think the average entrepreneur has much of a thought process regarding taking care of inventory? No. They're interested in inventing the next big thing, and so they would actually be better off with this whole field warehouse financing because these people are going to probably do a better job of securing the inventory. Do you think inventory theft is a problem? Oh, absolutely. And when we get to talking about inventory, I'll give you some examples from my own career of what happens when you don't leave your inventory locked up. Any questions? Okay, other short-term funding sources. The first one here is commercial paper. And commercial paper is any short-term debt with a maturity less than 270 days. 270 days seems like an odd number. The reason it's 270, that's more or less, 9 months? The Security and Exchange Commission requires you to register any debt longer than 270 days with them. And so it's cheaper to borrow less than 270 days because you don't have to go through all the process of registering with the Securities and Exchange Commission. When you register with the Securities and Exchange Commission, you have to create and publish a prospectus, which requires the involvement of accountants and lawyers and things like that. When you do commercial paper, you don't have to do that. And so commercial paper is a lower cost form of borrowing for that reason. Also, we know the normal term structure of interest rates, that low time to maturity borrowing is going to have a lower interest rate to it. Commercial paper was very popular before the financial crisis. But you had to have really good credit in order to do it. So it was like Fortune 500 companies, blue chip type companies that were able to take advantage of commercial paper. And in fact, there had never been a loss in the commercial paper market. But once the financial crisis hit and credit markets froze up, even good borrowers were having trouble borrowing money. Well, when you're only borrowing money 270 days at a time, you have to be borrowing new money to pay off the old on a fairly regular basis. And so if you've got a credit market freeze up of anywhere from like 1 to 3 months, suddenly you have good borrowers who cannot refinance their debt. And so the commercial paper market actually kind of disappeared for a while. Now it's starting to come back, but it's not nearly as popular as it was beforehand. Why would you do that versus going to the bank? Because it's cheaper. When you go out and you offer, and it's the same reason people issue bonds instead of borrowing long-term from banks. It's cheaper. What about using trade credit? A lot of people don't think about this as being a term of short-term borrowing, a source of short-term borrowing. But when people offer to sell us on credit terms of 30, 60, or 90 days, we can take advantage of that as an interest-free short-term loan. So if I buy $100,000 worth of goods today, but I don't have to pay for 30 days, I can think of that as a 30-day interest-free loan of $100,000. So we talked about this last time. What do we want to do? We want to wait until the end of the term to pay our bills. So if we've got 30 days to pay, send the check out on day 29. Questions? Okay, that's the end of that one. Now we're on to credit and credit policy. So first of all, let's talk about what credit is. When we send our products to the customer based on their promise to pay in a certain amount of time, we are extending them credit. So we are in essence loaning them money. So keep in mind that every dollar of accounts receivable out there has a dollar of accounts payable out there in the universe that's matched up to it, right? And so we were just telling you that you should extend the amount of time it's taking to pay your accounts payable. Well, where's that money coming from? It's from the extension of credit. And we're going to see that extending credit to your customers, it sounds free, but it's not. So offering credit is a whole lot like holding inventory. If we could get by without holding inventory, would we do it? Yeah. If we could get by without extending credit, we'd do it, because offering credit costs us money. So that $100,000, I could get that $100,000 today on cash terms and invest that money, or I wouldn't have to borrow as much money if I had that $100,000 now. But instead, I'm extending credit to my customers, and as a result, now I've got the carrying cost of that debt. When can we get by with not offering credit? If nobody in our industry offers credit, then we don't have to offer credit either. But what if one person in the industry starts offering credit? What's going to happen?
You get more business.
Yeah, they're going to get more business. And what is our response going to have to be?
Offer credit.
Yeah, we're going to have to start offering credit. This is the prisoner's dilemma. Have you guys heard of prisoner's dilemma? It's where you've got two parties. So the classic story goes like this. Joe and Bob rob a bank together, and the police can't prove it. But they take Joe and Bob and they put them in separate cells. And they tell them that if neither one of them confesses, that they're not going to get any time at all. If the other guy confesses, that they're going to get 10 years, but if they confess, whoever confesses first gets 5 years, whoever confesses last gets 10 years. And so what's the equilibrium solution for people in this situation? They almost always want to be the first one to confess. And it's the same thing with the credit. If whoever offers the credit first, they lead everybody else to have to do the same thing. And everybody is worse off as a result. Just like if both the prisoners had kept their mouths shut, everybody would have been better off from the prisoner's perspective. If nobody offered credit, everybody would be better off from the seller's perspective. Unfortunately, the draw is just too great, and someone will eventually start offering credit. I told you about my friend that went to federal prison for 7 years. Okay. And we were actually discussing the prisoner's dilemma in a class. And he said, don't ever trust your partner in crime not to rat you out. He said, I did time with people who were there because their sons, daughters, mothers, fathers, brothers, and sisters had snitched on them. And the reason they snitched on them was to avoid prison time themselves. And so if you find yourself in that position, take the 5-year deal. Better yet, don't commit the crime. Okay, questions so far? So let's talk about credit policy. The first thing we're going to talk about are the terms of the sale. And so you'll see them written like this, something like 210 net 30. And so the 30 is called the credit period. And that means that if I don't pay it off before then, the money is due on day 30. However, there's a discount. That 2 means a discount of 2%, and the 10 is 10 days after the sale. So if I pay within the first 10 days, I get a 2% discount. If not, then I have to pay the rest by day 30. If you're the one that are presented with this terms, if you're going to take the discount, on what day should you pay?
10.
Yeah, you should pay on day 10, right? Because you're able to get that interest-free loan for 10 days and you still get the discount. What if you don't take the discount Should you pay on day 11? No. When should you pay? Yeah, day 30, because you're getting that interest-free loan for as long as you possibly can. Now let's talk about credit standards. That's the required financial strength of our acceptable credit customers. You guys know hopefully about FICO scores. FICO scores are for individuals. For companies, we have the Dun & Bradstreet report. So Dun & Bradstreet is a company, and they go around and they collect information on different businesses, looking at their credit worthiness. And I've actually used this both to think about companies that we wanted to extend credit to, and I've also been contacted by Dun & Bradstreet for me to tell them about how well our customers paid us. That's one of the deals when you get into being a part of Dun & Bradstreet, is not only are you taking information, you have to provide information, otherwise that information isn't available. And so I can look at their Dun & Bradstreet report and get an idea of how likely they are to repay. And then we have our collection policy. We're going to talk about monitoring receivables and the obtaining payment on the past due accounts. And we're going to see that there are different levels of effort you can put into that, and you get different results, but of course there are different costs associated with that. So the executive committee creates the credit policy and the credit manager administers it. Now, the executive committee, who's on the executive committee? Well, I'm going to have someone from finance, and I'm going to have someone from sales. Those are the two people for damn sure who have to be on there. Probably the controller, maybe the chief operating officer. And the reason you want that many different people on that group of the committee that comes up with the credit policy is there are conflicting interests. So for example, let's talk about the sales manager. What does the sales manager want you to do with your credit policy? Do they want it to be super tight or do they want it to be relaxed?
Relaxed.
Yeah, they want it to be relaxed. Why?
Gives your customers more time to pay. It's like a set.
So you can sell more stuff. How do salespeople get paid?
Selling stuff.
Yeah, commission, right? And so, of course, as a sales guy, I was always wanting us to have the loosest policy possible for my customers. On the other hand, the finance people, what do you think they're going to say?
They want to tight.
Yeah, they want it tight because they're the ones that are going to have to chase these bastards down if they don't pay. So one time, this was when I first became a salesperson, and I said, who am I being assigned to? And they told me the name of the company. I said, you've got to be kidding me. That's the biggest blow molder in the world. Why would you assign a brand new salesman to that? And they said, because we pissed them off 20 years ago and we haven't been able to get our foot in the door since. In other words, we had nothing to lose. And so I go in there and I work to build trust. And then I get my first order and I'm so happy. I call back and my boss says, oh, that's great. We'll just have to run it through the VP of Finance so he can tell us how much credit we can extend to them. And we extended credit in a very weird way. We sold our products by the pound. And so regardless of how much each pound was selling for, we would extend credit in terms of pounds. So he said, we can extend them 500 pounds of product on credit. I said, you've got to be shitting me. 500 pounds will not last them a day. Because after all, it's the world's biggest blow molder. And the finance guy was like, well, we haven't had a business relationship with these people for 20 years. We don't know if they're going to pay in a timely fashion. And I said, if we don't extend them more than 500 pounds, we'll never find out. And so it finally got to the CEO's desk. The CEO was a former salesman. What do you think he did? Extended them the credit. And it all worked out. After all, they were the world's largest blow molder. The Dun and Bradstreet report was clean. It would have been insanity for us to do our normal little, boop, here you go, kind of extension of credit for them. So the credit manager then administers it based on this policy that they've put together. So let's talk about terms of sale. We've already talked about that 210 and the net. Let's talk about what that means. You get a 2% discount if you pay in the first 10 days. So let's assume that you buy $500 worth of merchandise. If you pay in the first 10 days, which we will say means on day 10, you're going to be paying 500 times 98%, which gives me $490. So I'm going to save $10 if I pay in that 10 days. However, I'm going to have to pay the full 500 if I wait the full 45 days. So let's talk about how we can calculate what is the true effective annual rate of these credit terms. In essence, what we're saying is that we're paying, so that discount of 2%, if we don't take the discount, then we're basically borrowing $98 for that remaining time period of 35 days, and we're paying $2 for the privilege of doing that. And so the period rate for this is 2 divided by 98. A lot of people get confused and think it's 2%. It's not. It's 2 over 98. What if the rate had been, the discount had been 3%? It would be 3 over what? 97, right? They always have to add to 100. And so I've got 2 over 98, and so my period rate is 2.0408%. And that period is 35 days. So when we do this kind of calculation, we always have to figure out how many periods are in a year. We've got 365 days in a year. We're going to divide that by the 35 days and see that that comes up to 10.4286 periods per year. Then we can use our effective annual rate formula, and we could say it's 1 plus the period rate, so that's that 1.02048, to the power of the number of periods, and then subtract 1. And that's going to give us an effective annual rate of 23.45%. But I'm going to show you another way to do this using your financial calculator. So if you got your calculator, please go ahead and get it out. Okay, here we go. So the first thing I want to do is say second and the number 2. What does it say above the number 2? ICONV. What do you think that stands for? It's interest conversion. It's where we convert from APR, nominal or quoted interest rates, to effective rates. And so we're going to be able to use that to do this problem. And when it asks for the nominal rate, that's the same as the APR. So basically, that is the period rate times the number of periods per year. So that nominal is going to be the period rate times the number of periods per year. So I'm going to say 2 divided by 98 equal, by the way, this is in percentage, not decimal, so I'm going to multiply that by 100. And so that's my period rate. but I've got to multiply it by the number of periods per year. Instead of calculating that separately, here's what I'm going to do. I'm going to multiply by 365 equal, and then divide by 35. So that's exactly the same as multiplying by the number of periods per year. And so if I take 2.0408 times 1.04286, I get 21.28 blah, blah, blah. And so I'm going to hit enter. If I don't hit enter, it's like it never even happened. And how do I know that I've hit enter? It's got an equal sign there. If the equal sign isn't showing, then we have not hit enter. Next, I'm going to roll up here, and this is the number of compoundings per year. This is the same as the number of periods per year. So I'm going to put 365 divide by 35 equals, that gives me this number of periods per year, and I'm going to hit enter. Once again, if I don't hit enter, it's like it never even happened. And then I'm going to arrow up. What do you think I should do now to get the effective rate? What button should I hit? I'll give you a hint. Look up top. What are the two words that you see?
Compute.
Compute and enter. Which one of those do you think we should go with? Compute. And I'm getting 23.452%, which is exactly what you would get using the effective annual rate formula. How should you go about doing this? Whichever way works easier for you. I don't care as long as you get the right answer. For most people, doing it the way that I just showed you is easier, but for some people who like formulas, this other one works better. Questions? So 23.45%. Do we really want to be, let's see, this is the company for benefits when customers choose to forego the discounts. So we would rather have them forgo the discount and pay us 23.45%. Does that make sense? So the question then becomes, when is it worthwhile for me to offer discounts like this? What if my borrowing costs otherwise were higher than 23.45%? Then it makes sense to do this. Does that make sense? If this were the cheapest form of financing we could get, it might make sense. If I could borrow money elsewhere short term at 12%, this wouldn't make any sense at all. So basically what I'm doing is using the discount to get people to pay sooner so I can have the cash sooner to work with. But that's coming at a cost to me. I'm basically paying 23.45, paying them, I'm paying 23.45% for that. Okay, let's talk about the cash flows from granting credit. So we have our credit sale. Does that mean we've collected any cash? No. And so then our credit or our terms are up and they send us the check. Do we have the cash yet? No. We have to actually receive the check and then deposit the check. And then when you guys deposit a check in your checking account, is the money immediately available for you? No. And so that whole time frame gets pushed out quite a bit. And that whole time frame is considered the accounts receivable period. We don't stop the clock on that until we actually have the cash available for us to use. So this whole thing is the accounts receivable period from the time of the sale until the cash is available for us to use. So receivables, we said credit was a lot like inventory, and in fact, accounts receivable is a current asset. that we have to invest money in, and that money has a cost to it. And so we have, so this investment that we're making, the idea is we are making that investment to produce sales. If we didn't have to do that, if we didn't have to extend credit to get sales, we wouldn't do it. So, how much is in our accounts receivable? Well, we're going to have our credit sales per day. By the way, that's average credit sales per day. And we're going to multiply that by our average collection period. What was another name for average collection period, or ACP? I'll give you a hint. It's 365 divided by accounts receivable turns. Oh man, it's days sales and receivables. Days sales and receivables is the same thing as the average collection period. And so we're going to take that average credit sales per day and multiply by the average number of days it takes us to collect, and that should give us the amount that we have in accounts receivable. So the greater our credit sales per day, the greater our accounts receivable will be given the same average collection period. And the longer the average collection period is, the greater our accounts receivable will be given the same credit sales per day. If we want to reduce AR, which one of those would we focus on? Do you want to sell less stuff every day? No. And so the focus would have to be on this average collection period. And that gets back to some of the tactics that we talked about previously, like picking up the phone and asking people to pay their bills. That's your reduction in your average collection period. So this firm is selling $1,000 a day on credit, and it collects in an average of 30 days. How much is it going to have in accounts receivable? Come on, this is easy math. $30,000, right? So let's talk about monitoring the receivables position. What does monitoring mean? I'm going to have to do something different here. There we go. What does it mean to monitor something? Keep an eye on it, right? So when you guys take your exams, that thing is called respondus monitor. We're trying to monitor you to keep you from wanting to cheat. And so we're going to be monitoring this receivables position. And it's not just managers who should pay attention to this. It should also be investors. And here's why. If you don't pay attention to this, you can end up with some pretty big losses. So managers can encourage sales to weak customers to report high accounting profits. I have a real story here. There's a company called Bausch & Lomb. Have you guys ever heard of Bausch & Lomb? They make contact lens solution and other stuff. But their big business at the time was making these laser eye surgery machines. Back when you guys were young, laser eye surgery was all the thing. And you had basically this huge market of eye doctors who wanted to get into this game so they could make some money. And so when Bausch & Lomb started making these machines, they couldn't make enough machines to satisfy the demand, and so they had very tight credit. And so only the eye doctors with the greatest credit could get their hands on these machines. And as a result, their credit losses were very low. But after a while, what does that mean? It means that all the great credit risk doctors already have machines, and sales start to drop off. And so the sales manager goes to the CEO and says, we need to loosen our credit requirements so we can sell more machines. And so they did. They eased up a little bit, and sure enough, sales went back up, and everybody was happy. But what happened then? The next layer down gets saturated, and so what do they have to do if they want to keep this game up?
Keep lowering their.
Yeah, they have to keep lowering it. And eventually, they've got Dr. Nick Riviera in a trailer somewhere in a Walmart parking lot, and suddenly Dr. Nick can't pay back for the machine, right? And so that eventually led to Bausch & Lomb's going through bankruptcy because they had loosened their credit so much and they looked great on paper. Now the trick is you can keep this up only so long. And a good analyst, like someone like a chartered financial analyst, will go out and look at the days sales and receivables. And you can calculate it using their income statement and their balance sheet. And what you're going to notice is their days sales and receivables is going to be going out, out, out. And this is a sign that they have been slacking off on their credit policy and on their collections. As soon as you see something like that, what should you do? Sell. And in fact, if you figure out that it's actually kind of almost a fraud, which Bausch & Lomb was, there's a possibility to short the stock, right? Does that make sense? Did you know shorting stock is dangerous? The market can stay irrational longer than you can stay liquid in a short position. I wouldn't advise you to ever do that. Okay, so we've been able to fool most of the people with our sales and our accounting. And so it works in the short term to boost the share price until people start to figure it out. And then the whole thing comes crashing down. The deterioration can also be unconscious. So I think I told you about the people I was doing the pro bono consulting for. They didn't intentionally let their customers slide. They had been used to their customers paying in a timely manner, and so that's what they expected them to do. And because they weren't monitoring that receivables position, it just got worse and worse and worse. And so it wasn't that they were trying to perpetrate a fraud. They weren't doing this on purpose. It just happens to you. It's kind of like getting fat. You guys will encounter this at some point in your lives. You wake up and you're fat and you don't know how it happened. It's not like you planned to be fat. It just happened to you. By the way, I am down 30 pounds from my peak. I speak from experience. So days sales outstanding, days sales and receivable, and average collection period are all the same thing. So let's go through an example here. A firm has credit terms of 210 net 30. What does the 2 mean?
The discount.
Yeah, 2% discount if they pay within how many days?
10.
10. And if they don't pay on day 10, when do we expect them to pay?
By day 30.
Day 30. So 70% of the customers are going to take the discount and the rest pay on day 30. By the way, I'm going to tell you this isn't a realistic example. In what case do 100% of your customers pay on time?
0.
Yeah, damn near 0. I've hardly ever ran into that. Now, so we're going to say 70% of them are going to take the discount, which means they're paying in 10 days. So I'm going to take 0.7 times 10 days and 0.3 times the 30 days because the remainder, 30%, pay on day 30. And that's going to give me 7 days plus 9 days gives me 16 days of sales outstanding. So we said earlier that you can get to this by taking 365 over the days sale or days the accounts receivable turns. You can also get to it through this manner. So our annual sales are 39.6 million. What are the average daily sales? What would I do to find my average daily sales? Yeah, we divide by 365 because that's the number of days in a year, and that gives me $108,493 in credit sales on an average day. By the way, we said it before, but I'll say it again. Unless you are told otherwise, assume all sales are on credit. Unless you are told otherwise, assume all sales are on credit. Okay, so how much should this firm have in accounts receivable? All we have to do is take that average day sales in average day credit sales, multiply it by the days sales outstanding, which was 16, and that gives us 1.74 million bucks. So that's 1.74 million bucks at any given time, on average, we should expect to have in our accounts receivable. So when we're thinking about how much we're paying to carry these receivables, that's the number we're going to be using. So what can we glean from this days sales outstanding? Well, one of the things you can do is compare to other people in your industry. So if let's say that you're in the shoe business, and you go out and look at other people's days sales outstanding, and their days sales outstanding are 30, and yours are 60. What do you think is the most reasonable explanation for that? What do you think their credit terms look like?
Sure.
Yeah, probably 30 days, and your credit terms, probably 60 days. If everybody else in the industry is getting by with 30-day terms, do you need 60 days? No. I mean, you could look at how much extra business you thought it was bringing in. What I would do is take it back to 30 days and see what happens, right? And if the business falls off, then we have a pretty good idea of how much extra we're getting as a result of having those longer terms. We can also compare the firm's days sales outstanding to its credit terms. So for instance, if I say a firm has days sales outstanding of 59, can you tell me if that's good or bad? No, you can't know until you compare it to their credit terms. If their credit terms are 60 days and they've got 59 days sales outstanding, then they're doing good. But what if their terms are 30 days? You're not doing good. Now, sometimes when I ask students about, how do we remedy this problem? We've got 30-day terms or people are paying on day 59. Most common student answer, well, let's just give them 60 days to pay. And then they won't be paying late anymore. Does that make sense? That doesn't make any sense at all. What are they going to do if we extend them out to 60 days? Yeah, they're going to go up to 89 days or maybe 119. Who knows what they're going to do? But I do know this. They will take advantage of you. I'll give you an example. I had a guy, so I was responsible for first and second shift. And my second shift came in at 3 o'clock. And it's my first day, and it's 3 o'clock in the afternoon. I'm going out to meet all my first shift people. And I get to this guy's machine. His name is Ramon. And Ramon is not there. And I'm like, where's Ramon? Everybody does this. 3:15, Ramon comes in, dragging ass. And I'm like, hey, Ramon, I'm your new boss. He's like, oh, hey. I said, what's your start time? He said, 3 o'clock. I said, what time is it now? He said, 3:15. I said, what's up with that? He said, well, he says, I've got these kids that I have to pick up from school, and their mother doesn't drive. And so that's why I can't make it until 3:15. And here I am, 25 years old, straight out of school, where they told us, about being the kind, insightful manager. And I said, okay, Ramon, how about this? What if we make your start time 3:15 and you only take a 45-minute lunch? Would that work for you? He's like, oh, yes, thank you so much, thank you. I said, oh, you're welcome. What time do you think he showed up the next day? 3:30, son of a bitch, on the dot, right? I told him after that, I'm like, no, we're not going to play this game anymore. You're going to be here at 3. And if you can't make it at 3, you're going to have to go to work somewhere else. And eventually that's exactly what happened. And what I did is I walked him through progressive discipline. Every time he was late, I would write him up. And I told him we got down to the last stage. And I said, Ramon, if this happens again, I'm going to be walking you out the door. And it was really interesting because he came in 2 days later and he said, I'm going back to my old job because they don't care if I show up on time. I said, good for you. And I helped him carry his toolbox out, and we put it in his truck, and he actually gave me a machinery's handbook as a parting gift. Expensive book. But, I'd walked him down the path. I'd been straight with him the whole time. He was not surprised when I walked him out the door. Now, one more example of how human scumbaggery comes into this kind of thing. When I was 16 years old, the speed limit was 55 miles per hour. It had been that way since the air boil embargo. And by the way, what speed do you think I drove when it was 55 miles an hour? 65. I drove 65. And then they raised the speed limit to 65. Do you think now suddenly Haggard is a law-abiding citizen? Nope, 75. And then when they raised it to 70, what do you think I did? 80. And then I get down to Arkansas at 75. What do I do? 85. I got down to freaking Texas. West Texas, and I can't remember whether it was 80 or 85. And I'm working really, really hard to go 10 miles over that, but at some point it becomes scary. Long story short, though, is extending the credit terms so people will be paying on time ever the answer? No, because they'll just take further advantage of you. Okay, so what can you do to reduce the day sales outstanding? What have we talked about? What's the big thing?
Just putting more effort in your collection.
Yeah, and make it personal. Give them a phone call. Give them a phone call. Just sending them a bill stamped overdue. I know, I can tell you from personal experience, getting those overdue bills at Walmart, it didn't make, that big red stamp didn't mean one damn thing to us, right? But what would matter? Call them up. Say, hey, why don't you send that check? Questions? So let's talk about the aging schedule. What we're going to do is we're going to take all of our accounts receivable and we're going to put them into different buckets. And the first bucket is going to be all the accounts receivable that are still within the discount period. And then the second bucket are going to be those receivables that are beyond the discount period but have yet to reach the term, so the net 30 or whatever. And then we're going to have different buckets after that. 30 days late, 60 days late, 90 days late. Now you cannot get this information by looking at people's inventory or looking at their income statement and their balance sheet. You can only have the kind of information necessary to construct buckets if you are actually inside the information, inside the organization with that information. Now, what can we do with the buckets? So we've got two firms here, and we have the exact same amount of accounts receivable. At first glance, you might think that these companies were in the same shape, but when we start looking at the buckets, we can see that one of them is in much better shape than the other one. Which one of these is in better shape? Supersets is in much better shape. In fact, all of their customers are paying within the agreed terms. Wonder Vision, on the other hand, has people going all the way out to over 60 days late. By the way, what do you think happens to your probability of getting paid the longer you let these things go out? Yeah, it gets worse and worse and worse. And so being conflict avoidant and being reluctant to call these people up and ask for the money actually decreases the probability that you'll get paid off, because the chances are they're just going to keep letting it slide, and your chance of collecting gets worse and worse. The chance of collecting the over 60 there, pretty damn bad. Pretty bad. Okay, So the next thing we're going to do is analyze some changes to our credit policy. And we are going to undergo an easing in credit policy. And of course, the reason we're going to undergo an easing in credit policy is to increase our sales. If it doesn't increase our sales, we shouldn't do it. If it doesn't increase our sales, we shouldn't do it. Now, what's going to happen? Well, first of all, our costs are going to rise. So think about the variable costs of all those units that we are producing and putting out there in the pipeline. If we are selling more stuff, we are going to have higher costs. That's not a bad thing. If we're actually selling them, I'm perfectly happy for my variable cost to rise proportionally. Okay, what about your accounts receivable? Well, it's going to increase due to that increased sales, but also because of your longer credit terms. And so we're going to talk about going from, say, 30 days to 40 days. We're going to have an extra 10 days of receivables there. And so in addition to the percentage of sales increase, we're also going to get those extra days on there that are going to boost that up. And our bad debts can rise if we're granting credit to less worthy customers. And this is exactly what happened to Bausch and Lomb. They had like near zero bad debt in the beginning, but when they start loosening their terms a little bit, they start to get a little bad debt here and there, but the further they go down, the bigger the bad debt gets. By the way, how do we deal with bad debt in accounting? Well, you have to do this where you're setting aside money to cover bad debts. Well, if you're a dirty scumbag manager, what do? You underestimate the amount of bad debt. And so that's one of the things that happens is when the bad debt chickens come home and you haven't set enough money aside, suddenly we have a negative surprise to report in our earnings. And our discount expense will rise if we increase the discount percentage or the discount period. So if we go from 2 to 3% and keep the same terms, it's going to go up by 50%. If we keep the same discount and we go from 10 to 15 days, it's going to go up 50%. So both of those can increase our discount expense. I think, if you don't mind, we'll stop here today and we'll pick up here next time. And then we will get into inventory. So if you haven't read the inventory readings, please go ahead and do that. See you next time.